Hi, I'm Chris Wren, Principal at Highland Financial. If you're worried about protecting your assets, if you own a business, if you want to pay less tax, the video you're about to watch could help you make vital changes in your financial life. Through a conversation between myself and a respected lawyer, you'll find out all the essential things you need to know about trusts, including the different types of trusts, how trusts can help minimize tax, how you can protect your assets through a trust, how to plan for the future using a trust structure, and how trusts can be used for succession planning. At Highland Financial, we work with clients every day to help protect the assets they have worked hard to build, and we can do the same for you. Asset protection is a critical area of your financial life. Can you really afford to not take care of it? If you think we can help you, call us right now and make an appointment to come and see us. Thanks for stopping by our website today and taking some time out to learn more about trusts, trust structures, and how they could apply to you and or your business. My name's Chris Wren and I'm the Principal at Highland Financial here in Brisbane, Australia. I'm talking with Paul De Silva today, a Senior Partner at the distinguished law firm McCrossan's Lawyers, also in Brisbane. Hello, Paul.
Hello, Chris.
Thanks for taking some time out today to talk to us about trusts.
It's a pleasure.
I guess the first question is, what is a trust?
Well, a trust at its most simplest is when someone holds property for another person. The person that holds the property is the trustee. The person who's actually entitled to the property is the beneficiary.
Okay.
The property itself is what's normally called the trust fund.
Right. So I guess what you're saying there is that there's different types of trust then?
There are different types of trust. The most common form of trust is the family discretionary trust.
Okay.
Here the trustee has a discretion as to which beneficiaries will receive income or capital under the trust deed.
Okay.
So there's a general discretion. You can have it so that there is no discretion. Those sorts of trusts are called unit trusts.
Mm-hmm.
And then you can have combinations of the two of them, which are called hybrid trusts.
Okay. A trust structure, as I understand it, is an entity of sorts that would hold things like property and or assets, or maybe even a business. So why would you want to do that?
Well, you might want to use the concept of a trust, for example, to spread your income, that is, income earned from the assets held by the trust. If there are a range of beneficiaries under the trust deed, the rates of tax payable by those various beneficiaries may differ. Some may have a high rate, some may have a low rate. So it may be in the interests of whoever controls the trust deed to distribute income to those who have a lower rate of tax. Mm-hmm. Of course, in doing so, they would have to make sure of the effect on those people's rates of tax, because they will probably be bumped up.
Right. And if you get it wrong, there's certainly penalties for...
Well, if you get it wrong, the penalties could be penalties under the Tax Act, or the penalty may be the higher rate of tax payable by the beneficiary.
Right.
So some care is needed.
Okay. So these trusts or trust structures, they've been around for a long, long time, haven't they?
The concept came in probably round about Henry VIII's time in England, and there are stories amongst lawyers that one of the catalysts for the concept was so that the royal families didn't lose their assets and their descendants didn't lose the benefit of them if they were on the wrong side of dynastic struggles. So if someone lost their head, normally they lost their assets. If the assets were in a trust, then the hope was that the families wouldn't lose the benefit of those assets.
So for some of the viewers who may have heard of a term called self-managed super funds, they're effectively a trust, aren't they, as well?
Yes, a self-managed superannuation fund is a form of trust. Mm-hmm. The trustee here manages the superannuation fund. Mm-hmm. The beneficiaries are what are normally referred to as the members of the fund.
Oh, I see. Yep.
And the trust fund are the various assets held under the superannuation deed.
Okay. So all trusts have what you call a deed, is it? The rules, is that what you'd call it?
You need a piece of paper to set up a trust normally. Mm-hmm. And that piece of paper will set out the relationship between the trustee and the beneficiaries.
Okay.
It will set out details of what the trustee can do. For example, with a superannuation fund, it will set out the powers to invest the money.
Right.
It will also set out when the members of the superannuation fund are entitled to their benefits and what age and how they might take those benefits.
So it's not like a set up once, set and forget type of thing. It's a thing that needs to be looked at, reviewed from time to time?
Trusts in general should be reviewed from time to time. You will ask why. Well, for example, the tax rules change from time to time. The rules relating to superannuation funds change fairly regularly. So the documents need to be reviewed to make sure that they are consistent with the current law and also to take advantage of what benefits are available under that law.
Okay.
But going a bit further, trusts can be established under a will, for example. Here, a trust formed under a will is normally called a testamentary trust.
I see.
And people often use that structure to protect assets on an ongoing basis and to protect, for example, assets against failure of marriages for beneficiaries. Are sometimes used there.
Right. So we've found some applications for trusts that they can help with taxation planning. We've talked about holding assets in a trust, which means there's, I guess, some asset protection that you can get from a trust.
If you've accumulated substantial wealth, succession planning involves who will have the control and ownership of those assets after your death or after your retirement, and what controls, if any, should be placed on those.
Isn't that taken care of in a will?
A properly structured will should consider such matters, and often they are so considered. And here you have to think about not only the end result that you want, but the practical setup of a family, children, grandchildren, what the needs are of those families, and also the tax implications for what you're proposing to do.